You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Options Bootcamp, the program for you, the busy retail stock trader. Maybe you're a little bit flummoxed by what's going on in these markets from a volatility perspective. You want to learn a little bit more options terminology. Maybe you want to dip your toes into those options waters, but you don't know where to go. You're afraid you don't know how to swim. Don't worry. We'll be your lifeguards here on Options Bootcamp. My name is Mark Longo. I will be your host, your guide, your maitre d', one of your lifeguards here, nay, your drill instructors here on the old Options Bootcamp drill instructor proving ground. If you like what you hear on this program or anything else on the network, make sure you keep those reviews coming. New folks are flocking to the network every day out there. We want to keep that flow going. We want to keep new folks discovering a sane and reliable source of options content out there. Some of the stuff we talk about on this network, there's really nobody else out there talking about. So if you want people to keep discovering this stuff, and if you like what you hear, you want to share it, get out there to your platform of choice. Leave reviews, leave comments, leave kind words. We like to see all the positive reviews. So many of you giving us 5-star reviews. We love to see that. Thank you so much. We appreciate it. And of course, keep those questions coming. We do love to hear from you, particularly on days like today, where we're going to answer a lot of said questions. Before we get to that, let me introduce my fellow question answerer, a.k.a. my fellow options lifeguard, a.k.a. the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, also the author of, I don't know, one or two options-oriented, options, really just options-adjacent tomes. Dan, welcome back to the program, sir.
Very good to be back. Very good to be here.
You like that? Is that in your marketing brochure? Options adjacent tomes?
I'm going to work that in. Yeah.
Not quite option centric, more adjacent. You're in the neighborhood. You're in the neighboring lot, shall we say. All right. With all our nonsense out of the way, let's keep on rolling. It's time for you guys to take the reins. It is time for your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. I love that intro. I love that transition. It just makes me feel like the 4th of July. Even though we're recording this a little bit after Labor Day here, it's always 4th of July here on the old Options Bootcamp program. It's also always a good time for you guys to hit us up with your questions. We've had some epic ones of late. Maybe we'll go a little bit shorter on the questions today to focus on some of those, but I'm sure one or two epic treatises will sneak in. If you want to hit us up, you know where to find us at Options on most of the major social media platforms, or of course our website, theoptionsinsider.com. Or if you want to listen live, you can ask questions there as well. You folks get bumped up to the top of the queue. Of course, email questions@theoptionsinsider.com. No shortage of ways for you guys to find your way to our program. Just like our first questioner here, this comes from Mel. Mel wants to know, am I correct in assuming that the desirable skew shape for a collar type investment would be low volatility on the puts and high volatility on the calls? Am I reading that correctly? Thanks for the shows. Well, short answer to your question, Mel, is yes. a longer answer, if you're confused with what they mean by skew, listeners, check out our recent episodes. We talked all about that at some length. And of course, we hit on it in the past in our archives as well. So go back. If you haven't done so already, check out the show from episode 1 all the way through to now. By the time you get to now, man, you're going to know so much about options. You're going to feel supercharged with options knowledge. But we talked very recently about skew, in particular what Mel is referring to here, which is called investment skew. And what is that, listeners? Well, that is the phenomenon we see mostly in equities, but it can happen in other commodities and things as well. But it's primarily known for equities and equity indices, which is the phenomenon where the puts trade at a higher implied volatility versus the calls. And why is that? Well, we talked about it in the last show, but of course, let's say the S&P right now. Everyone's long the S&P, right? In funds and individual accounts, whatever it might be. Everyone's long the S&P. They're riding it up to these lofty levels. What do you want to do against a long equity position? Well, a couple of things. First off, you're probably going to want to hedge it at some point. So that's the buying of the puts component. That's where that comes from. And of course, that buying activity over time drives up the put price, the put volatility as a result. What else are you going to do? You're going to sell calls against it, either for straight up income or maybe to pay for that put, as Mel talks about, the collar. So now you're going to have a scenario where the calls are depressed from an implied volatility perspective. You put those two positions together, long stock, long a protective put, and then short an out of the money covered call against it. Now you have what is known in the industry as a collar. Why is that? Well, you've kind of collared your returns. You can't drop too much because you get stopped out at that put strike, and it won't really rally too much because you're stopped out at that call strike that you sold. So that's what a collar is. Mel wants to know, is the right skew shape for that a low volatility in the puts and a high volatility in the calls? The answer is yes, because you want cheap puts. The cheaper, the better. And you want very expensive calls. The more expensive, the better. Why? Because you want to pay less for the put. You want to get a lot for that call. In fact, it's not a setup you're going to see very often in most equities, I'm afraid, there, Mel. It's just not a thing you see for the reason I just described. Most equities are set up to do the opposite, actually, to sell puts and buy calls, create what's called a bullish risk reversal. Instead, if you're curious what that is, check out our archives for more detailed information on that. It gives you an approximate long delta position in the underlying without a lot of outlay. So it's an attractive thing if you like the levels where you're selling that put at in particular, because you might end up buying that stock there. So yeah, the skew shape, the investment skew, tends to be more favorable to bullish risk reversals than it is for collars, because you're paying up for that put, you're not getting much for that call. That said, we were just talking on our TWIFO program, This Week in Futures Options, and this may be a little bit outside the realm for some of the listeners here, but we were talking about soybeans, in particular soybean meal. And that one was a scenario, that was a commodity where the puts were fairly cheap and the calls were fairly expensive. So that's a scenario. And soybeans in the past has had that set up a few times. So if you're looking for places where they are favorably set up from a skew perspective for collars, often you have to look outside of the equity realm. You have to get into the commodities. And right now, at least for the time being, Mel, soybeans are looking very collar friendly. Dan, any thoughts here for Mel with questions about collars, or maybe any suggestions where she can find some collar friendly underlying, sir?
Yeah, I mean, here's the thing with collars, in my opinion, is you're almost always going to find that skew that Mark just described, where the puts are a higher vol than the calls and thus more expensive, relatively speaking, same proportion way. So, I mean, like, you put on a collar not because you're getting edge. Like I'm the biggest proponent of getting edge on all your trades, but that's not why you put on a collar. It's not a trade. It's a defensive mechanism. It's a hedge, and you're always giving up some edge on it. So, I mean, you know, if you've got concentrated wealth, like you worked for some company and you've got $5 million worth of their stock and you're nervous about the market or that stock, you know, you can't be like, gee, I don't know, the puts are a vol point above the calls. I'm going to skip it. You know, like, you can't do that. You just got to kind of bite the bullets and maybe give up a little bit of edge on them. So yeah, in my opinion, I wouldn't worry too much about that, which is the only time I'm ever going to tell you not to worry too much about the volatility levels.
Uh-oh, Dan preaching for ignorance here on the Options Bootcamp program.
Ignorance is bliss, no?
Yes, ignorance is bliss. But yeah, you're not going to find a favorable setup for collar. You may find underlyings that are more or less expensive than others to collar, but they're all going to have some sort of premium to the puts out there. So you're going to have to probably go beyond that if you just want to do collars. But I don't know why you just want to do collars. You usually want to start off finding an underlying that you like and want to trade options on, and then go from there rather than looking, hey, I have to do collars. Let me go trade soybean meal. Not the right way to go. What was that listener's name there, Mel? But a good question nonetheless. Seems like people have skew on the brain from our recent episodes here, Dan. Next one comes from, I like this handle, Last Mountain. Sounds like a sci-fi character, or maybe a location on the map of a sci-fi/fantasy story out there. So Last Mountain wants to know, I'm a new subscriber to OBC, is what the cool kids are calling Options Bootcamp listeners. He says, and I'm listening to the new episodes while trying to catch up on the older ones. The most recent episode about expensive puts had me thinking that maybe the proper approach for stock indexes is to sell out of the money puts rather than to use them as a hedging tool against long positions. Is that your conclusion as well? What are your thoughts for this approach? Sounds like Dan, the Last Mountain, has awakened to the magic of selling puts. You know, I kind of joke whenever I go to industry conferences like the risk management conference that SIBO used to put on back when we went to things like conferences. And I used to always joke that was effectively the harvesting the risk premium conference. It seemed like everyone collectively awakens every few years to the magic of selling puts, just like you are right now, Last Mountain. You're saying, wait a minute, these puts are kind of expensive. The calls are kind of cheap, as Mel discovered. Not exactly desirable or suitable for callers. Perhaps I should go the other way, which is sell the puts or do, as I mentioned in the last question, the bullish risk reversal. And that is certainly an approach that has a lot of merit out there to it. I mean, we've said very basically, and again, we talked about selling puts many times on this program. Check out our archives for our full thoughts on that. But the short crux of that really is that if you're comfortable working limit orders in a stock, either buying stock with a limit order or selling stock with a limit order, then you should be comfortable selling a put to get into a stock position and selling a call to get out of it. That's the very basic use case for these things. And what you're discovering now is that, yeah, puts are overpriced from a vol perspective, usually. So harvesting that risk premium there is attractive. And it does outperform, depending on the study you're looking at, versus holding the underlying and a bunch of other things. There's mountains of data on this Last Mountain. Check out some of our other shows like Volatility Views and the Advisor's Option, where we've talked about some of that data in the past. Or go to the CBOE RMC website. They have papers galore there about this exact topic. How do short puts perform in a variety of scenarios? But the thing you want to remember, of course, is that if you're selling that put, first and foremost, you want to be comfortable buying that underlying at that strike, whatever it is, SPY, soybean meal, whatever the hell you're selling the put on. That's how you want to view it from that lens. And if you're not, maybe you don't do it, or you go down to a lower strike where you are comfortable. And then the second approach to that is maybe you want to consider, if you're still worried, using a put spread instead of just a put. So instead of just banging out naked puts, the put spread, selling puts is great. And it's one of those strategies that works until it doesn't. And you have to have a strategy in place for what happens when it doesn't. You're just going to lose your house, or you're going to perhaps do a spread to mitigate that risk, or do some other strategies we talked about on this show in the past. But yes, short answer to your question, in general, just given the investment skew shape that we talked about before, selling puts is going to be more favorable than buying them over the long run. That is certainly the case for a variety of reasons we don't have time to get into here yet again. Check out our archives. Dan, your thoughts here from Last Mountain also has a skew-related question. He says, is it better to just maybe sell the puts rather than buy them, sir?
Yeah, I used to, many years ago, I used to talk to people who, well, we were just talking about this on the last show, between 2008 and 2018 or whatever it was, where people were just like, oh, yeah, all I do is sell puts. Like, nope, I don't want to sign up for any classes because I just sell puts and it always works. And, I used to be kind of down on puts, being like, hey, man, it's not always going to work. And they're like, oh, it's worked 20 months in a row. It always works. It's like, so I think some people in the past might have felt I was down on puts, but I'm really not. When used properly, and part of using them properly is cash secured and actually having the objective of buying the stock. Not tricking yourself into thinking, oh, it's okay if I buy the stock, and then when it goes down and you get a sign, you're like, what the hell's got the key to strike? You can't be like that. It should be part of your actual objective. And then it can be an amazingly great thing. You can scale into stocks and in the long run outperform the market.
Yeah, I mean, look where we are at now. We're nearly 3,400 in the S&P. If you're comfortable buying S&P at 3,000 and you would be willing to work a limit order to buy it in said brokerage platform of choice, then you should be comfortable selling a put around that level. And you get all the benefits we talked about on recent shows, the inflated volatility out there. Just make sure, again, that's a level you want. And if not, you don't do it, or maybe you adjust, or of course, you can always use a spread as well to protect you. Cash secured puts, another good way that Dan mentioned. If you don't know what that is, again, check out our archives for more information. All right. Next up, Scroll. Scroll wants to know, hola. Well, hola, Scroll. Says, great podcast. Well, thank you. He said, I listen on Podbean. Oh, you're one of the growing Podbean army. I wasn't even that familiar with Podbean until a bunch of you started hitting us up a few months ago. Apparently, we have a decent following on Podbean there, Dan. So if you like it on Podbean, Scroll, and everyone else, more power to you. We don't judge. Get the show however you like, whatever's most beneficial to you, whatever's easiest for you. If you want to just stream it on YouTube, it's available there. If you want to get it on Apple Podcasts, Google Podcasts, buy our own app. We don't talk about our app as much here on the show, but we have an app that's got everything we've ever done in it. So if you want to just mainline options, and chances are you have the time on your hands right now and maybe the inclination to do so, grab our app. It's available in the iOS and Android app store. It's got every episode we've ever done, 13 and a half years. Listeners, you will have some options content to sink your teeth into there. So if you want to mainline options, grab our app. That's the place to go. All right, Scroll wants to know, what are your thoughts on hedging using inverse ETPs like SQQQ? I've done pretty well this week using it. It seems pretty easy for most people to understand, and there's no theta/vega to worry about. Easier for the grandmas and other basic traders to understand as a portfolio hedge. You know, Dan, we get this question all the time. People tend to like these inverse type products. I tend to call them Franken products for a variety of reasons, not the least of which is that they're attempting to approximate some other position. And God knows how they are doing it. Typically in the inverse space, listeners, they're probably using derivatives of some sort to do that. In what ratio and how they're setting it up, is it the best way to do it? Who knows? Most of these products, it's a crapshoot what you're getting out there. So in that sense, would I recommend you using the Franken products? Probably not. Again, I'm an options guy, so I'm speaking from the options lens. And also your point that it's easier for the grandmas out there, you know, yes and no. The concept of it moves in opposite of, so I buy it, is easier. You're right. But on the flip side, there's a lot of other things that are inherent in these inverse Franken products that you have to know about in order to understand them. For example, how often do they rebalance? If it's a daily rebalance and then grandma's is going to buy it and hold it for a year, that's probably not going to work out too well for her because it's rebalancing every day. Or maybe it's another product, like let's say a VXX out there. That's not inverse, but it's trying to approximate a VIX futures position. What happens to that? Well, it has a whole bunch of terrible negative roll yield that just eats it away. If you buy and hold it over time, you're going to lose a lot of money. It's one of the best value destruction vehicles ever invented. So depending on the vehicle and what they're trying to do, how much of a Franken product it is, there is actually a surprising amount of learning involved. There's a learning curve with these products, even though they seem very simple on the surface. So no, I would not say they're good for grandmas and basic traders for all the reasons that I've set out. If you want to do it yourself, you can. We've taught you how on this show many times. Check out our archives. Dan, what do you have to say here for Scroll, who thinks these inverse Franken products are good for the grandmas and the basic traders out there?
Mark, I could not agree with you more. They're a disaster waiting to happen. And you know, like the thing is like, consider what your objectives are and consider what tools exist before getting fancy. Like, I think people like to look at these like, ooh, it's this new thing. I'm going to do it. I'm going to go tell everybody on Twitter and, you know, how smart I am. But like, usually there's a way smarter way of accomplishing what you're trying to accomplish. And, you know, one of them sometimes is just sell the thing, you know, the asset that you have and be out of it. Like, that's a hedge. Go to cash instead of said asset. You know, there could be tax consequences. That doesn't work every time, but you know, there's collars, which we were talking about. I think that was on the last show. You just don't need them. They're fancy for no reason, and they're potential disasters waiting to happen.
Yeah, if you want to be inverse the S&P or inverse, in this case, NASDAQ, you can always buy a put that works. So you can do put spreads if you want to do minimal outlay. There's collars, other things we've talked about as a way to finance those put spreads with kickers, all the other things we talked about to finance those short positions you want to take on. There's other ways to do it as well. You can sell call spreads, all sorts of things we've talked about here many times on the show. We won't get through all of that. Many ways to get spreads with wings we just touched on recently. No shortage of ways for you to express those viewpoints using options in a risk mitigated fashion that you understand and can control, as opposed to this kind of willy-nilly Franken product that you don't really know what the heck they're doing over there. All right. Dan, I joked at the top of the show about the epic listener treatises, but I think it's time for one of those. This comes from, this is your buddy here, Baiju. I think he's the one, Dan, that you unfairly maligned on a recent show and said his name was inspired by a Chinese liqueur. So I think we owe him an epic treatise, sir. What do you think?
No, I if I'm not mistaken, I emailed with him, or maybe that was a listener who was listening to me maligning by Joe over here. Either way, yeah, let's hear from our friend.
All right, let's see what he's got here. All right, Baiju says, "Hi, Mark. Thanks to you and Dan for answering my questions last time." Yes, he was the one who Dan said was a Chinese liqueur inspired person. He says, he has two questions this time around. So my two questions are around a website that I use. There's a function called order sentiment in here that looks at the volume on bid, ask, paid, collected to determine if traders are bullish or bearish on a stock. Below is how it reads. And he says order sentiment, they interpret, I won't say the name of the site here. We'll just talk about what the order type is. Order sentiment is interpreted as the way traders might feel about the future of a stock's price based on what they're buying on the options market. Call trades that are bought on or above the market's asking price are considered bullish, expecting a move to the upside. Put trades that are bought on or above the market's asking price are considered bearish, an expectation of a move to the downside. We exclude complex order types as they might be part of a larger trade. So his question is, what is your point of view regarding this kind of analysis? Did you use it much in your time at the pits? Second is, who really knows, looking at the OI at a strike, if it is net long or net short? And why is this confidential info? Do regulators not want to reveal where traders are positioned? This is probably why the order sentiment also exists, right? It's sort of a closest educated guess. We'll do the first part first here. Yeah, we do this a lot. We listen to our option block program, in particular, the odd block segment there where we're analyzing unusual activity. We look at put a lot of analysis into where that order is executed and how it's executed. If they're lifting the offer on something for 10,000, yeah, they're probably buying it, and they probably have an expectation that this thing is going to go up if it's a call or if it's a put to go down. There's other things they could do. They could do it tied to the underlying. That changes the analysis, and you have to dig a little bit deeper sometimes, look at what happened on the implied volatility on that strike. That will give you sometimes a better sense of what's happening if the execution is misleading. Remember, they can also put these up marked late, and that's when they look like they're trading through the offer or trading through the bid, when in reality, they just put it up late and it has nothing to do with where that market was at the time the order went up. So there's a lot of things that could be misleading. You can't just look at where the order was executed. But yes, it is a good starting point for analyzing all of this. And the second question, why don't we know what's going on with the OI? This is another frequent question we get. People are used to putting up a trade. They hit a button, it's executed in milliseconds, right? And so they say, well, trade is done. I sold these calls. I'm opening. Why can't the OI reflect that instantaneously, or at least more often than once every 24 hours? And, I put this question to a lot of people in the industry because the tech is there. You're right. It does exist. I talked to folks at OCC about this. I talked to trading firms, brokers, market makers, exchanges about this. And it seems like there are multiple camps. There are the retail folks like you who want this stuff instantaneous. Secondly, there are some other orders that kind of make it a little bit more difficult. If you're just selling the 10 lot of calls, sure, that's pretty easy. There's a lot of other stuff going on that's not quite as obvious right away as to what's opening and closing. And also, there are parties out there that are pretty influential. Some of the market-making firms, some of the trading firms, and others who probably, they want that little bit of cushion. They want that day of wiggle room for people to really know what they have on. And they've advocated pretty strongly. They like a little bit of the opaque nature of options from an OI perspective. So they push back against that kind of trend, which is why we probably won't see it anytime soon, but I think we will eventually get there. At the very least, some midday updates that I propose this, maybe a midday OI update. Okay, so you do it at noon. You do it again after the close, as opposed to just, because I agree with you, once a day is pretty archaic at this point. Dan, what are your thoughts here from Baiju's Epic Treatise? First off, do you like his order sentiment type analysis? Is that something you use? And then B, what are your thoughts on why can't we get more insightful and immediate updates on OI, sir?
Well, as far as the order sentiment, just on the surface value answer to this question is no, I don't like it, which is different than what you said, but I'm not necessarily disagreeing with you. I'm just looking at what you're looking at, but also something else.
That's it. I'm hanging up on you right now, sir.
The thing is that a lot of people don't realize is that the options market is doing two different things for two completely different user groups. One is position traders, which often are taking direction, but not always are. And the other is volatility traders. And volatility traders are bigger traders than directional traders. And so if 1,000 lot goes up, especially if it goes up mid-market, I mean, that could very well be a volatility arbitrageur buying those calls, not because he thinks the stock is going up, probably never even looked at a chart of it, only looked at a volatility chart of it. And he's going to delta hedge it to get delta neutral and expect volatility to go up or gamma scalp it. So like it's okay to analyze volume and open interest along with time and sales, along with like all these other things, but it's way more complicated than most people make it. Most people say, oh, look, a bunch of calls traded. That means it's going to go up, which is not necessarily true at all. It could mean there's a volatility arbitrageur who thinks volatility is going up and doesn't have any opinion at all on direction. Could be somebody closing that, could be part of a spread, could be part of, like a pairs trade spread. So like if you're going to look at value and open interest, you've got to look at a whole bunch of other data points to make good sense out of it. Otherwise, you're going to fool yourself and you're going to lose money. And so, it's not really like it's confidential. I mean, it sounds like Mark had more conversations with people about the possibility of being able to do that or not to list it real time or more often than every 24 hours. But, back in the day, like stuff had to settle and, it's like anything else. Like you get used to doing something for 30 years and like, nothing changes unless it's brought to their attention. So, I imagine the technology exists now to do open interest real time, but I just think it doesn't help most people.
This is an interesting topic. I think we could talk about it for quite a long time, but we're kind of running up against it. I think I agree with Dan. But the use case I was outlining there, Baiju, is for individual trade analysis. That's how we do it. I don't really use it in aggregate, and it sounds like maybe this order sentiment uses it in aggregate. That's why, for example, you don't hear us talking a lot on this network about call to put ratios. I don't put a lot of stock in those for the reasons Dan kind of just outlined. There's other things going on out there. But an individual trade, if you want to analyze it from its own intent capacity and what the trader is attempting to do, that's when I find this type of analysis is useful. But in aggregate, not as much. That's why I don't quote calls to puts and all these other things all the time. And the latter one about the OI, I encourage you. I did a great sit down. I think it was about over a year ago now, because there was no OIC this year, a year and a half ago or so, at OIC of last year on our interview program with John Davidson, the CEO of the OCC. They're the ones who handle all this stuff. And I put that exact question to him. So go check out that episode if you are so inclined in the archives of our Options Insider radio program, or in this network feed. You got to scroll back a bit and you can see exactly what he says. He actually was a little bit more optimistic than I thought he would be about that happening sometime in the future. I thought he would be very resistant to the idea, but he actually seemed like he was somewhat embracing of the topic, which kind of surprised me. So check it out there for yourself. Maybe we'll have it sooner than I think. All right. And last up here, because we're kind of running up against it, I like this handle, Altheist. Maybe he's a fan of Alf, or he's just, I don't know what he is, but I like the handle nonetheless. He or she wants to know, how can I trade the VIX index itself? I don't want to trade futures. Well, I hate to break it to you there, Altheist, but you're kind of out of luck. VIX itself, I know what you mean. You want to trade that index that everyone is splattering over there on CNBC and every other financial outlet and site out there. They quote the VIX. And you say, oh, the VIX is 33. I want to buy it. I want to buy it at 33. Then you go to do that and you realize, oh, wait, I can't. I have to either buy the option on some future, and there's a whole term structure of futures that go all the way out for years. So if you don't understand futures, that's a little bit of a daunting prospect. I encourage you, check out our Volatility Views program if you are so inclined, because that's a good starting point for that. You have to be comfortable trading futures. You can't just buy the future if you want itself, or then you can buy the option on the future. You still need to have a futures-enabled account to do so out there. So there's a lot of things that kind of gum up the works, or you can buy some of these Franken products I talked about earlier, like VXX, which attempts to replicate a long VIX future. Now, the problem with that, how do you do it, right? There's a lot of different ways to do it. Do you replicate a front month future? Well, guess what? Then you have to rebalance all the time, and that's going to cost you money, which is what happens with VXX. Or do you go a little bit farther out? Maybe you make some sort of aggregated basket of futures to try to approximate somewhere on the term structure that you think is the sweet spot. Every different person you talk to is going to have a different way of doing that. But at the end of the day, they have to rebalance, they have to adjust. It's going to eat into the returns. And that's what happens with products like VXX. Some folks did try to do exactly what you're talking about. Professor Whaley, who was kind of the VIX father himself, attempted to create a product that would allow you to do this. They ended up morphing it into what became VIX up and VIX down. And if you look for those now, you're going to see you can't find them. I encourage you, look into the prospectus for those products and the just Byzantine, Herculean lengths they had to go to create those products and the distributions. And if you want some good reading before you go to bed at night, I encourage you to read that prospectus of just the lengths they had to go to create that product and how it was so obtuse, no one could wrap their head around it, let alone trade it. And it kind of went the way of the dodo. So the short answer to your question is, unfortunately, you can't. VIX is this weird beast. They created it. It's super popular. Everyone loves it. And yet you can't really trade it. So it's this weird kind of catch-22. And so as a result, there's this whole ecosystem of VIX-related products out there that you can trade. But VIX itself, a bit of a challenging one. Anything to add there, Mr. P?
You don't have to trade everything there is out there. Like, why do you want to trade it? There's plenty of stuff to trade. Professor Whaley, like, Google an article. I don't know what you Google. Maybe like Robert Whaley, investors lose money or something. He in an article, this is even a few years ago, he estimated that investors lost something like $2 billion or something investing in these VIX products because they don't understand them. They don't really understand exactly how they function. So, I mean, in a way, when something is very complicated and difficult to understand, if you're the guy who understands it, you can get an edge. But if you're just like, yeah, I think the VIX is going to go up, I'm going to buy some of these futures, you are going to be the guy that everybody else is making money off of. So, if you're going to explore it, you've got to really, really dig way under the surface and really freaking get it. Otherwise, there's plenty of other stuff to trade, man.
Other stuff to trade, man. I like that. We'll have to leave it there. Interesting. I do recall the period you're talking about there with Mr. Whaley. That was, I do believe, in the run-up and the leading up to the launch of that VIX up, VIX down I was referring to earlier, where he was kind of maligning some of these other products like VXX. In fact, I do believe he was referring to VXX in particular. And a lot of those articles and interviews he was doing, he was kind of turning into a bit of a marketing guy for his own product, obviously. And so he was kind of slamming everything else, which I slam VXX too. So I think that's fair game out there. But read into those articles. It's kind of interesting. He kind of exposes some of the interesting nuance and challenges of trading these products. But yeah, short answer, Altheist, can't do it, at least not the way you want to. All right, that music means we come up against it. I want to thank all of you out there for sending in your questions, large and small. We love them all. And before we go, Mr. P, if folks want to hit you up about trading the VIX or order sentiment or any of the other fun topics we talked about today, or just about anything else, maybe your favorite band, I don't know. Where should they go? What should they do, sir?
Yeah, join me over at markettaker.com. Just hit the Contact Us button, and I'd love to share some thoughts and help out however I can.
And also share your favorite band with them. Don't forget that, sir.
Oh, indeed.
I think you're a big Inagata Devita fan out there, right? It's the Iron Butterfly. All right. On behalf of Mr. P and Andy, myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in such great questions. Keep them coming. And we'll see you back here next week for more Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.